Hey guys, what's going on? In this video, we're going to explain how you can easily beat the markets in the next 120 to 160 days utilizing a simple trading strategy introduced to you here at 13 Market Moves that focuses on trading historic analogs. Many instances in the past, we have been able to precisely point out the pivotal critical conditions of trading the markets on both bear and bull instances where you've been able to create astronomical returns in your trading accounts. Now, in this particular case, we're going to break down in detail the trading analog based on the charts of 1974. What we're really going to focus on in helping you understand how easy it is going to be to trade the markets in the next 4 months, especially if you understand the 13 Market Moves sequences. So let's take a closer look at 1974 historic analog right here. We're looking at a time frame between basically April, May. Now, you'll notice there's a lot of real close correlations to the current market conditions, such as the market topped out or made the last run up higher in March before a horrific April, right? These market conditions of a bad April I only observed a few instances in the history of the United States market. And so the fact that in 1974 we had a very substantial move to the downside highly resembles the 2022 market conditions. So despite of all the top fundamentals, we started picking up on this pivotal turn where everybody normally would be highly bullish in April, such as pointed out in prior videos. JP Morgan, a lot of Wall Street traders, they were bullish in the market, saying, well, statistically speaking, April is a highly bullish month. In one of those videos, I brought to your attention the fact that indeed there are instances in the history of the United States market where some big downturns in the market began in April. So such is the case in 1974. Now, needless to speak of the inflation conditions, a lot of other things, let's fast forward to this part of the chart. Now, historic analogs, they're not going to necessarily run day by day, precisely, accurately with the current conditions. So there is a wiggle room for a few days to up to about 10, 14 days on day-by-day candle situation. So based on what we study and following this historic analog, we are currently in this part of the historic analog, which in 1974 shows in July, but we are officially, I'm recording this on June 25th, 2022. So there's a little bit of room here as far as the day-to-day comparison, but the pattern is there. And if you focus on this pattern, guys, you will be amazed of how easy it is to trade this market. Now, I'm not saying it is going to be psychologically easy. What I am saying is going to be pattern-wise. If you get this information in the next 10 minutes, you're going to outperform 99% of the traders. And so to help you accomplish that, I'm going to actually zoom in on this 1974 chart, and I'm going to allow you to compare the time frames of bounces in relation to the drops. We're going to look at a percentage of the days where the market bounces or has a green day in relation to the red days. We're also going to show you the approximate value of the increase of the market during such bounces in relation to the drops. So let's zoom in and take a closer look. So based on our calculations, next few days, the market is going to be going sideways to higher until we ultimately hit this 4,065 area. Now, of course, that number could be slightly off. We could go to 4,030. We could go to 4,100. But I'm going to show you why we believe starting to short right about a 4,000 area based on this historic condition, which I specifically drew this arrow right here to point out that the market tops out in 1974. Or it doesn't necessarily top out, but what it does is after a preceding series of drops, it finally makes this attempt to move higher. And this attempt to move higher doesn't last very long. Also notice that it is not a straight cumulative action higher as we see finally in the late stages of this chart right here in October. So what we're talking about is an orderly attempt grind higher in the markets over the course of the next 5 to 10 days. Now, it may not even run as many days as it did in 1974, but we just recently had a couple of green days in the market, and we're somewhere in the middle of this part of the chart if we were to compare it to 1974. In a second, I'll bring the current chart so you can visualize this a little bit better, but just focus on the number of white candles for the whole month of July in 1974. So we're talking from this part of the chart all the way down to this part of the chart. And if you calculate the red candles versus the green candles are about 40% of the trading days. So generally speaking, there's going to be like 22, 23 trading days in each month. And we'll take the trading days and how many of them were green days. Okay, there was only about 40%. So automatically, just using this basic statistics, okay, you're better off in 60% going bearish within that time frame, despite of seeing some clearly bullish candles that are developing. Now, notice that any bullish action is normally subdivided. It is interrupted. So, for example, you have bullish candle here. Well, on the third day, you're destined to get a red candle. This pattern is quite obvious. You get bullish candle, bullish candle, followed by another red candle. And pattern is slightly interrupted here, but the idea is the same. You get 3 bullish days, and after that, you get a red candle. So at the most, we're looking 2-3 days interrupted by a sideways move or a red move that ultimately resolve into a much longer move to the downside. So if you count the red candles right here, 1, 2, 3, 4, 5, 6, 7. So you got 7 days uninterrupted. Okay, the key word is uninterrupted, because when you're trying to trade a sequence with 13 market moves, your best trades are going to be the ones that most of the traders online here on YouTube, they will never ever catch them, because those traders are trying to catch $100 a day, 500, couple $1,000s a day. They're not really focusing on the overall pattern. They're not really focusing on the overall sequence of the move. And if you focus on this chart with me, you will see how predictable this pattern really is over the course of the next 4 months. So basically, the number of green days, okay, is significantly lower than the number of red days. And the number of green days will be interrupted quite frequently by a sideways move or a red move in between. When we compare that to your ability to trade the market, okay, the reason why most of the traders, they don't get to see, you know, exponential returns in a trading account, because they can't stay with the trade. They jump into the trade, 2 hours later, oh my God, I see something green in my account, and they jump out. And so, for example, a trader may get into the trade right here and jump out on the next red day right there, maybe realizing a small gain. But the trader will miss out on red day number 3, 4, 5, 6, 7. So trader's going to miss out on 5 days where his bearish trade would be incredibly profitable. So don't make that mistake, guys. If you struggle, the number one reason why many traders have contacted us lately is because they're saying, look, Leo, oh my God, I could have made so much money, okay, if I listened to you, but every time I get into a trade, I jump out, I only realize small gains, okay. I want to get rid of that habit. I want to understand what are the market conditions for me to actually stick with the trade. So these are the conditions, guys. When you have a highly repetitive pattern that is uninterrupted, there's 7 red days here. In other words, you can put on a trade, sit on it for 5 to 7 days. And the reason I say for 5 to 7 days, because if we analyze the next stretch of red candles here, now notice, how many white candles do we get? 1, 2, 3. It means 3 green days in the market, followed by 1, 2, 3, 4, 5, 6, 7, 8. 8 red days back to back, guys, interrupted by just one bullish day, 1, 2, 3, one bullish day, 1, 2, 3, one bullish day, sideways, okay, 2 bullish days, and we get 1, 2, 3, 4, 5 red days. And in this instance, we're getting 9 red candles. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 days in the market, just lower. Notice, these are not huge moves, okay? So you just got to be extremely patient with your trade. But if you take any interval right here from July all the way through the beginning of October in 1974, you're getting a clear picture here that if you just put on your trade and you stay patient with it for 5 to 9 days, I mean, these are some major home runs, guys. And so make sure you're not in a situation where you're putting on a good trade and then you're jumping out of it the next day. Now, clearly you would need to get in the beginning of the trading sequence. So maybe now you're looking at this pattern, it's quite simple. Okay, you could get a few green days, but then these green days are going to be highly outnumbered by consecutive move lower and a sequence of red day, and so on. So if you understand the basic of this pattern, the next criteria you will really need to nail these trades over the next few months, guys, is understanding when is that first red candle. Okay, normally it's going to be followed by, it's going to be right after a sequence of a few bullish days. All right, but even with that, okay, clearly, I mean, we're not looking at exact 100% match here of day-to-day activity. So you would need some help. You would, number one, you'd need to understand the 13 market smooth formula, and ideally you want to trade with a coach, okay, who basically 20 hours a day studies this stuff. Okay, we got a number of guys that are absolutely exceptional with keeping track of these 13 market moves, guys. And certainly, if you really want to have the hands-on experience, then working with a coach could really get your experience to the next level. Now, understanding this pattern, right, overall we would call this a bounce, okay, and a much bigger drop. If we analyze this bounce is very short-lived, followed by a much longer drop, even though there's a couple of bullish candles here, but they don't last long, right? If we take a month of August in 1974, guys, this is huge. I mean, we're talking about only 21% of all trading days are green days. I mean, this gives you an insane probability. I mean, 80% potential win rate if you are on the bear side and if you understand when to actually time your entry, which is what 13 market moves can help you with. Okay, short-lived bounce again, right here, just a couple of days, followed by a uninterrupted sequence of red days. Smaller size bounce, right? The bounces are at the most, okay, 1, 2, 3, 4, 5. I mean, you just want to use it as a rule of thumb. Market goes higher 5 days in a row. Get ready to short it, damn it. I mean, it's that simple when you understand this historic analog. Now, understand also the conditions that are matching current conditions as far as the chart. Again, there's a lot of fundamental conditions that clearly match the current economic conditions to that 1974. But what we have is a pattern. All of this pattern is developing under the blue line, okay? And if we switch to the current market conditions in 2022, make sure that you understand your entry in relation to that blue line. We're going to take a look at it in just a second. Now, overall, what we're saying is right now the market is going through a sideways to slightly bullish pattern. That's likely to be finished up in the next 4 to 5 days. So in the next 4 to 5 days, okay, we can get a mix of candles, meaning there's going to be some candles that are going to be red, some candles that are going to be green, but overall they're going to be moving in this direction right here, slightly to the upside. Now, the market finished recently just right at about 3,900 Friday, yesterday on the 24th. So we still believe there's going to be a roughly of sideways to slightly high action. We can reach a level of about 4,000, 4,065. And from there, by October, we can hit a level of 2,881. Okay, now this is a simple percentage. If we take the percentage differences in 1974, apply same percentage in the drop, to the current market. So 28.81 at some point in October could be the bottom in the market, and then we get a slightly bigger bounce. As you can see, the pattern really breaks in October, where the number of green candles, clearly white candles in this chart represent the green candles on your trading screen. Not until October till we break this highly bearish pattern. And you can see that the number of positive candles or green day candles, they're going to be matching and slightly exceeding the number of red candles. The percentage here changes to 56% of trading days are going to be green days. So as far as the next 90 days, guys, to 120 days, I mean, we got some really, really strong percentages where the number of green days is going to be capped to an absolute minimum, anywhere from 21%, 36%, but no more than 40% is the number of green days. So anytime you get, 5, 6, 7 days higher in the market, it gives you an insane probability of going short, because this pattern is likely to keep playing out, not just for another week, not just for another month. This pattern is likely to be playing out just like in 1974 all the way to October. Hopefully that makes sense. And at this point, we're going to glance at the current market conditions. So we're here, 39.11. We still got some room to go sideways. Don't expect every day to be a big green day like we had yesterday on Friday. Those sort of candles, they're not very common. On certain occasions that will happen, but we're likely to get a scenario of candles like this and like this. So notice the size of the move is going to begin contracting, and it could take us a few days to try to climb here to the 4,000, 4,065 area. Now, ideal entry would be just under the blue line. Okay, so you can keep checking your stock charts daily to see exactly when we're very close to the blue line. Because notice, at times you're going to have some overshoots. That's why I'm putting this area of 4,065, potentially even 4,100 to be an ideal entry point. But look, in severe downtrend markets, bear markets, okay, oftentimes you will get close to the blue line, but you're not going to touch it. So our last perfect entry was right here, guys. We posted the video on a 333 move right before this red candle happened, this red candle, this right here. You had a solid 333 move. Now the market is slowly grinding higher, and increase and expansion of the move here. At some point, this key levels are going to play a very meaningful impact on the market's ability to move higher. So once we get closer to the blue line, this would be a point to start looking for a great entry on the put side. In instances, again, look at this blue line right here and the relation to the candles. It's a small overshoot. It's not like the market is running way up here right before it drops again. We're talking just a small overshoot here in the prior action. And if you can see all the other points on this chart, see the market goes close to the blue line, but not quite touching it. Real close right here. All these were your ideal entry points to short the market. And then it drops and then bounces. So you got slightly an extended overshoot in this instance. Okay, and you got a smaller overshoot in this instance. So we're expecting the blue line just under it to be our first entry. Slightly above that, 4,100 level would be our second entry, in expectation of a much more meaningful downtrend to be resuming. Again, I want you to focus on the size of these red candles. They're not huge. They're not like the size of the red candles that we've nailed on the 333 move. But nonetheless, the overall direction after this bounce is going to be resuming again, and all you have to do is nail your entry and stay with the trade. Do not jump into a trade knowing there's potentially nine-day lower move in the market overall. Focus on the bigger move. I can't believe that certain traders Okay, they just get into a trade, they get out 10 minutes later. Get into a trade, they get out. And when I asked them, well, why would you do that? Don't you want to make some real money? Aren't you sick and tired of just trying to get a couple $100 out of the market when it gives you the opportunity to make a couple $100,000? Their answer is normally, oh, but Leo, but I'm afraid, man, what if it starts reversing and going? Well, expect it to start reversing and going against you. Expect your trades to go against you temporarily. This is a stock market. It's moving. You're in the middle of it, trading weekly options. The values are going to be changing all the freaking time. What do you expect? To get into a fucking trade that nothing moves? No. It's the stock market. It's designed to move. Somebody's buying, somebody's selling. Of course, at some point in the day, the trade will go against you. So expect it. Expect that your account will go in the red. Okay, but overall understand that even though temporarily the trade can go against you, overall, over the course of 8-9 days, your trade is going to be meaningfully in the green. Okay? And if you understand this pattern, just looking at it right now, but you know psychologically you're going to have a hard time actually implementing it, then this is your reason why you should click the link below or go to 13marketmoves.com, schedule a 20-minute coaching call with the senior trader here, guys. I have worked with some of the smartest people in the world that are trying to conquer the stock market, and where they all fail is the psychology. Okay, they understand the chart after they've taken our courses, but what they really need help with is the psychological aspect of trading, being able to stay with the trade 100% of the time. And being able to stay with the trade 100% of the time does not mean that you're going to win every day. It doesn't mean that your account is going to be green every day. You're trying to capture a bigger move at one point in the day. Certainly the trade is going to go against you because nothing drops in straight line. There's going to be bounces. But this gives you a really solid path to understand that, hey, things could go against you for a little while. But overall, with a course of 5 to 9 days, if your entry is good, guys, this is the simplest market to trade. We have not had a market that simple in years. So use this. And if you need help, okay, not just understanding this, but actually somebody to hold your hand so you can stick to the strategy, so you can stick to the plan, so you can actually see your account, okay, have a breakthrough, then again, get some help, get a coach, get your account moving in the right direction. So with all this stuff right here, guys, very easy entry, okay, but you've got a stair step in it. And, you know, overall, you know the strategy. You know where to do it. You want precisely, okay, sign up to trade with a coach, and your coach will tell you exactly when he's entering the trade. Now, here's some other things to show you that will just blow your mind away, guys. This is the market that have such a strong correlation with 1974. It is absolutely stupid not to pay an incredible amount of your attention to this chart right here. So this is dollar in 1974. And as you can see, dollar is about 105, 106 level right here. And it tops out about August, September, one more time, okay, at a level about 104, 105, and then it goes sideways, okay? So this is absolutely insane, right? Understanding this information, that dollar actually double tops right around the level of about 105 with a little overshoot, guys. This is exactly the action in dollar that we have just seen. Now, if you watched my videos in the last few months, I've been pointing, hey, the dollar could double top at around 104, 105 level. We went slightly above that. As you can see, we almost touched 106. But how can this even be? I mean, these are the same levels on US dollar from 1974. I mean, we're within millimeters. This is as good of a historic analog as you can possibly dream about as a trader. So the dollar tops out, double top at the same level as in 1974. So you may be wondering, well, what is then the best trade? I mean, clearly you can go in and short the market. But if we were to really look at the price action of gold in 1974, that was your best trade because the percentage of gains in gold actually outperformed the percentage of drop in the market. Now, clearly, it is a lot easier to be buying puts when you know something's going to be going lower for 5 to 9 days if you nail your entry. However, this gold trade could actually outperform. And I will say this, I've been trying to chase this gold trade in the last couple of weeks, just like I have been just a little bit earlier on my mRNA trade in the last couple of years. We're piling up into a lot of calls in mRNA at around 200 level. It got to 230 a couple of times and retraced back to 210, 200, right before it rocketed all the way to $495 within an incredibly short amount of time. So when I'm looking at this gold chart, the most recent example I can give you how some things could be looking bearish, right? Because if you're looking at the price action right here, well, it doesn't look so bullish. Leo, it sells off. What are you talking? What kind of bull can you be here? Well, I'm going to show you the current chart because the conditions are insanely similar, and that's exactly when gold takes off. And from 130 to 195, guys, that's 50%. But the time frame, guys, it does that within 5 months, 150 days. Gold moves up to 50% higher. Guys, in terms of options, I mean, this is huge because that means, given current market conditions, gold can move from $1,800 to $2,700. We're talking about a humongous trade here, guys. Okay, and the chart is very similar. I want you to look at this blue line and orange line. Do you see how blue line starts going lower? The orange line is higher. Basically, normally this would be considered like very bearish because ultimately what normally would happen, you got the blue line doing this and the orange line is doing this, so you got a def cross. Normally that type of development would lead to a strong drop in whatever it is that you're looking to trade. But if we look at this historic condition, if we look at the double top on the dollar, if we look at what the market is doing, combine it with the current conditions, gold's got a real case. And right now, gold, for whatever reason, especially the last few days, it's not even catching a bid. It's just doing stuff that it's not supposed to do, which could be the last final few days right here. If we go back to the 1974 analog, we could say, okay, well, gold is somewhere right here if we're to apply it to the current chart of gold, which means from here you got 50% potential upside in the price of gold in next 5 months. When we think about the cost of options in relation to the size of the move, this could actually be the ultimate trade of the year. Now, take it with a grain of salt because every time, I get super excited about the trade, it does not end up being my best trade, and you should know that. If you've traded with me in the past, I'll give you like 2 or 3 trades for the day, and I'll say like, hey, this is my favorite trade for the day. Well, the favorite trade for the day doesn't do nothing, right? But then the other 2 trades that I thought weren't as good, those are the trades make you 800%, 1600%, whatever. So based off everything that I have looked into, guys, this could be the best trade of the year. There's been a lot of gold bulls. Okay, now they're saying, well, the economy is going into the recession, but it wasn't the recession back in 1974, and it did not stop gold from rocketing higher. But there have been so many gold bulls out there, right? I mean, starting with Peter Schiff and a bunch of other guys out there. Well, gold 7,000, gold, 5,000, so on. The question is, do we have the current market conditions, okay, that could be not priced in by majority of the market participants? In other words, they've been bullish on gold for so damn long, okay, they don't know the timing. They don't know the timing when gold is actually going to take off. So I think looking at this chart, it's going to look like on the current chart that gold is going to drop. So look at this. Remember the conditions? The blue line is doing what? It's going lower. The orange line is really not moving. It's just going a little bit higher. And normally we'd see an intersection and a def cross right here, the price drops. Okay, but in this particular case, considering everything that we study here at 13 Market Moves and the current historic analog that we're utilizing, I think it's going to do this right here. I think gold could take off at any given moment. I'm not saying it's going to take off Monday or at some point next week, but very likely in the next 10 to 14 days, gold could go on one of the biggest home runs in its history that we have not seen dating back to the 1970s, 1980s type situation. So be ready. This is not the trade that I'm suggesting you take right now. You could start biting into this trade, little bites. Understand that you're targeting the bigger move. So you could simply put a longer term option expiration instead of doing weekly or monthly. You can even go a few months out and just potentially, have an insane trade here. Now, knowing this, okay, you're going to say, well, 50% higher from current levels is going to be this level of 27.45. Please, whatever you do not make the stupid mistake that most of the people that watch this channel do again and again and again, which is buying the 2700 strike in gold. That's bullshit, okay? You would have taken any of our courses, guys. If you work with a coach, you know that is the very elementary mistake that not even a 5-year-old would dare to make who has studied 13 Market Moves curriculum. Okay, your target price, which in this case is $2,745, should never coincide with your strike price. Okay, so basically what you're looking at doing is the price right now is $1,830. You want to get a strike that's, $1,950, $2,000, okay, $2,050, okay, something that is still priced exceptionally lower in relation to this potential huge breakout, okay, but your goal is to be in the money. So if the price indeed goes to 2,700, all of these strikes, by the time of when we're expecting this trade to play out, the next 120 to 180 days, by that time frame, okay, you would be way in the money on this trade. So your goal is not to buy the strike that coincides with your ultimate target price within the time frame. Your goal is to buy a slightly out of the money strike, which will be in the money by the time the price accelerates to the upside. That also protects you in case the historic analog is not 100%. Okay, meaning could the price go to 2,400? Well, sure, but if you buy the 2,700 strike, well, you're not going to make the money. I mean, this is ideal case comparison, right, to where it can go to 2,700. What if it goes to 2,550? Okay, but you bought the 2,700 strike. Well, overall, the trade makes sense. But guess what? If you hold it till expiration, okay, those options aren't going to be worth anything. Not the 27.45 strike. So please do not make that mistake. And if you're struggling with understanding this, even after I explain this, guys, you've got to get a coach to work with you who will spend a little bit more time explaining you how this stuff works. Okay, but for the purpose of this video, do not be ever buying a strike price on your options that coincides with your target price. Simply put, if the stock right now is at $80 and you think it's going to 100, you do not, under no circumstances, buy a 100 strike call. Okay, you want to buy at 85, 90. So by the time your target price is hit and the stock is trading at 100, you would actually be in the money on your call option. And the same applies to the put option. If you think something's going to drop from 200 to 180, don't be buying a 180 strike price. Okay, you would only be buying 180 strike price if your target was under 180. So if your target was 168 or 172, then it would make sense to buy the 180 strike put, because by the time your target price would be hit, you would be in the money on your put. So if you need help with understanding this, guys, make sure you click the link below, schedule a coaching call. But for those of you that are ready to rock and say, hey, Leo, I am ready. I'm ready to take my 50K account to $1 million plus, guys. Don't wait. Start training with a coach today. Study all the courses, guys, before you do. It'll make the job of your coach a lot easier to help you get your account to $1 million plus. Okay, and it certainly would give you the confidence to stay with the trade. I mean, if you're trading with me, number one comment I'm going to send you is like, hey, stay with the trade. I'm telling you that for a reason, because if you're going to stay with the strategy 100% of the time, okay, you have a chance to beat the market. If you're just going to keep jumping in, jumping out, jumping in, jumping out, I promise you, the market will beat you. Sometimes it'll beat you beyond the point of return. So don't allow the market to do that to you, okay? Stay strong, stay 100% with the move sequence. Yes, there's going to be losses at times, but overall, your account will be green if we take a sequence of 6 months, 12 months, guys. And right now, with the market so easily readable, okay, don't wait. Take action today, study the courses, sign up to trade with 13 Market Moves Coach, and get ready to rock. I'll see you guys in the next video soon.